Between 2018 and 2020, Americans were told they were witnessing a turning point. Headlines declared a historic confrontation. Tariffs were announced with urgency. Political leaders from both parties claimed the United States was finally standing up to China after decades of unfair trade, intellectual property theft, and manufacturing decline. The message was simple and emotionally satisfying. America was fighting back. But while the public was focused on speeches, press conferences, and trade war theatrics, a very different story was unfolding beneath the surface. During those exact same years, not before, not after, Wall Street moved approximately $1.4 trillion into Chinese markets. This was not retail money. This was not speculative capital. This was institutional capital. Pension funds, endowments, sovereign-linked vehicles, and the largest asset managers on the planet. That alone should raise a question. If China was truly being isolated, sanctioned, and economically confronted, why was capital flooding in at record levels? Why would the most sophisticated financial institutions in history move trillions into a country supposedly being economically challenged by the United States itself? The answer is uncomfortable, but simple. Wall Street was not reacting emotionally. It was responding to structure. Because capital does not follow flags, speeches, or public narratives. Capital follows cycles. And by the late 2010s, the cycle had already shifted. Most people believe financial power is driven by politics. In reality, politics exists downstream of finance. Governments argue. Capital reallocates. Elections change leaders. Balance sheets change systems. What looked like betrayal was actually recognition. Recognition that the American financial system had entered a late stage of its life cycle, while China was still earlier in its expansion phase. Every dominant monetary system in history follows the same progression. It begins with centralized control over money creation, usually justified by stability. That control enables cheap credit, debt expansion, and rapid growth. Over time, the currency becomes dominant beyond its borders. Other nations hold it. Trade settles in it. Assets are priced in it. This is the golden age, and it creates the illusion of permanence. But that illusion never survives mathematics. Eventually, debt grows faster than productivity. Growth becomes financial rather than real. Money creation accelerates to sustain obligations that cannot be met through taxation alone. This is not corruption, it is arithmetic. And when the system reaches this phase, the currency begins to lose quality, not overnight, gradually. This is where the misunderstanding begins. People expect collapse to look dramatic. They imagine crashes, bank failures, and panic. But mature financial systems don't collapse loudly, they erode. Purchasing power weakens, asset prices inflate, savings lose meaning. The public feels pressure, but markets remain functional. This phase can last years, even decades. And during this phase, something critical happens. The institutions closest to the system, the ones with the best data, the longest time horizons, and the least emotional attachment, begin to reposition. Not because collapse is imminent, but because returns are shifting elsewhere. By the late 2010s, the United States was deep into this stage. National debt had reached levels that could no longer be normalized. Central bank balance sheets had expanded beyond anything previously considered temporary. Interest rates had been suppressed for so long that the system itself depended on them staying low. The dollar remained dominant, but dominance was now being maintained structurally rather than organically. At the same time, China presented a very different profile. Lower household debt, state-controlled capital flows, massive ongoing infrastructure investment, an economy still expanding its industrial base rather than merely financializing it. From a capital perspective, China was not safe. It was early. And in financial terms, early beats safe. This is why Wall Street's move wasn't ideological. It wasn't about supporting China or opposing America. It was about relative position in the cycle. Capital doesn't ask which system is morally superior. It asks which system has more runway. One of the most misunderstood mechanisms in this transition was the role of global investment indices. By the late 2010s, capital no longer moved primarily through discretionary decisions. It moved through benchmarks. When Chinese equities were added to major global indices, trillions of dollars were forced to follow. Pension funds didn't vote on this. Endowments didn't debate it. Allocation happened automatically. This is where the public narrative and the private reality diverged completely. While politicians spoke of decoupling, the plumbing of the financial system was quietly integrating China more deeply than ever before. Index inclusion meant legitimacy. Legitimacy meant access, and access meant capital. During the height of the trade war, Wall Street did not retreat. It expanded. Asset managers increased onshore exposure. Investment banks secured regulatory approvals that had been impossible a decade earlier. Financial infrastructure was being built, not dismantled. To the average observer, this looked like hypocrisy. To anyone who understands financial history, it looked like repetition. The same pattern had played out before. British capital moved into American industry before the pound lost reserve status. Foreign capital entered Germany before hyperinflation destroyed domestic savings. Gold left the United States before the Bretton Woods system collapsed. In each case, the public remained loyal to the currency and the narrative. The institutions quietly moved ahead of the transition. The $1.4 trillion that flowed into China was not a gamble. It was not a protest. It was not betrayal in the emotional sense. It was a signal that the financial system itself was shifting centers of gravity. And once capital starts moving, it rarely reverses. To understand why Wall Street's repositioning matters, you have to abandon the idea that financial systems fail because of bad decisions. They fail because of design limits. Any system built on debt expansion eventually reaches a point where additional debt no longer produces real growth. At that point, monetary policy becomes maintenance rather than progress. The United States reached that point long before most people realized it. After decades of global dominance, the dollar-based system had become self-referential. Financial activity generated more financial activity, but less tangible output. Asset prices rose faster than wages. Productivity gains slowed. The economy appeared strong, but lived increasingly on leverage. Central banks responded the only way they could: lower rates, larger balance sheets, emergency tools becoming permanent features. What was once unthinkable became normal. And with each intervention, the system became more dependent on continued intervention. This is not failure. It is late-stage behavior. Meanwhile, China was building something structurally different. Not better. Different. Capital controls limited sudden outflows. State ownership ensured alignment between long-term planning and financing. Infrastructure spending remained a priority, not a stimulus. From a Western perspective, this looked inefficient. From a capital perspective, it looked stable. Stability in finance does not mean freedom. It means predictability, and predictability attracts large, patient capital. That is why Wall Street's largest institutions were willing to tolerate regulatory complexity, political risk, and cultural friction. They weren't chasing short-term profits. They were securing position in what they believed would be the next dominant financial ecosystem. The trade war, in this context, was never meant to reverse the flow of capital. You cannot meaningfully confront a rival economy while simultaneously integrating it into global financial infrastructure. Tariffs affect goods, capital allocation shapes systems, and capital allocation was moving in the opposite direction of the rhetoric. This does not require conspiracy. It requires coordination through separation. Politics handles public sentiment, finance handles long-term positioning. Both can operate simultaneously without direct conflict because they answer to different timelines. The result is what we saw: public hostility paired with private integration. The American population was told a story of resistance, while American capital quietly financed China's financial maturation. For most people, the consequences of this are indirect but profound. Savings denominated in a slowly debasing currency lose value without dramatic collapse. Wages lag behind asset prices. Economic anxiety rises even as markets reach new highs. This creates confusion, frustration, and polarization. But from the system's perspective, this is expected. Late-stage systems transfer value upward and outward. Early-stage systems absorb that value and convert it into growth. The real betrayal, then, is not that Wall Street moved money to China. The real betrayal is that the public was never taught how the system actually works. People were encouraged to think in terms of loyalty and politics, while capital operated in terms of cycles and structure. By the time the consequences become obvious, by the time currency weakness is undeniable, by the time alternatives are openly discussed, the positioning is already complete. That is how transitions have always occurred. The $1.4 trillion was not a warning shot. It was confirmation that the transition phase is already well underway. The question is no longer whether the global financial system will change. It always does. The only remaining question is who understands the mechanism early enough to adapt. History is unforgiving in this regard. Those who cling to narratives lose purchasing power. Those who understand structure preserve it. This has nothing to do with patriotism or ideology. It has everything to do with literacy. Wall Street did not betray America out of malice. It moved because the system it serves demanded repositioning. Capital does not wait for permission. It does not ask for consensus. It simply flows where the structure allows it to grow. And right now, that structure is shifting. By the time capital migration becomes a mainstream conversation, the most important phase is already over. History shows this clearly. Financial systems do not announce their transitions in advance. They complete them quietly, then explain them afterward. This is why late awareness is so costly. By the time people begin asking questions, the advantage of early positioning has already disappeared. What happens next is not a sudden collapse. It never is. Instead, the system enters a prolonged period of distortion. Asset prices continue rising, but purchasing power keeps falling. Markets remain active, yet confidence erodes. People work harder, save more, and still feel poorer. This is not contradiction. It is redistribution. Value is being transferred through the currency itself. At this stage, governments lose flexibility. Every policy option carries a cost that cannot be avoided. Raising rates risks destabilizing debt. Cutting rates accelerates currency debasement. Printing money buys time, but destroys trust. The system no longer chooses solutions. It chooses delays, and delays always favor those who moved early. This is why institutional capital behaves differently from public capital. Institutions do not wait for clarity. They move on probability. They do not require certainty, only direction. And once direction is clear, speed matters more than explanation. The public, on the other hand, waits for confirmation. By the time confirmation arrives, positioning is complete. China's role in this process is often misunderstood. This is not about China winning in a traditional sense. It is about China being the recipient of a cycle transition. Capital always moves towards systems that are earlier in their financial development. Before America, it was Britain. Before Britain, it was the Netherlands. Before them, other empires played the same role. The destination changes. The mechanism does not. What makes this transition feel more unsettling is that it is happening in real time, in a hyper-connected world. Information travels instantly, but understanding does not. People see the symptoms, inflation, instability, political tension, without seeing the structure beneath them. That gap creates anxiety, polarization, and confusion. The most dangerous mistake at this stage is believing nothing is happening because nothing has collapsed. Collapse is not the event. Collapse is the outcome of a process that has already run its course. The real event happened years earlier, when capital quietly changed direction. This is the final stage of the pattern. The population holds currency. The institutions hold assets. The system continues functioning, but no longer serves the same group it once did. History does not reverse this process. It completes it. This was never a story about politics, tariffs, or national rivalry. It was a story about cycles, financial cycles that have repeated for centuries without exception. Every reserve currency follows the same path. Every financial empire believes it is different. None of them are. The $1.4 trillion that moved was not a prediction. It was a decision. A decision made quietly, rationally, and without emotion. Not because collapse is imminent, but because transition is inevitable. By the time these shifts become obvious to everyone, the most important moves are already behind us. The question is no longer whether the system will change. It always does. The only real question is whether you understand the pattern while it is still unfolding, or only after it is finished. This is not fear. This is not speculation. This is pattern recognition, and the pattern has never failed to complete itself.